Imagine being denied your dream house or car just because of a three-digit number. Yes, that's your credit score. This unassuming figure holds a lot of power, acting as a key to unlock many doors in the world of finance. It's like the financial pulse that lenders check before deciding whether to extend you credit or not. Whether it's a mortgage, an auto loan, or even a credit card, your credit score plays a crucial role. Whether you're a fresh graduate, seasoned professional, or someone aiming for financial milestones, understanding the nuances of credit is pivotal. Today we'll break down actionable strategies to boost your credit score, from establishing credit responsibly to navigating the intricacies of credit utilization. Welcome to Money Funnel, your ultimate gateway to financial empowerment. Get inspired, get motivated, and learn the path to true wealth so you can live the good life. Please help us grow this channel by subscribing now. Don't forget to hit that like and notification bell for more motivational and financial tip videos. So, what exactly is a credit score? Simply put, it's a numerical expression of your creditworthiness, a reflection of your financial health. Lenders use it to gauge the risk they take when they lend you money. A higher score means you're less of a risk, and thus more likely to get approved for loans or receive lower interest rates. Your credit score, often likened to a financial report card, distills your creditworthiness into a numerical expression. This three-digit number holds significant influence in determining your eligibility for loans, credit cards, and other financial opportunities. Essentially, it's a snapshot of your financial health, offering lenders insights into your repayment history, credit utilization, and overall reliability. The higher the score, the more favorable terms you can secure. Understanding the factors that shape this numeric reflection is crucial. Now that you know what a credit score is, let's move on to understand how it's calculated. Ever wondered how these three digits are calculated? It's not magic, but a rather straightforward formula. The process involves a meticulous evaluation of various financial factors, each assigned a specific weight, culminating in the numerical expression known as your credit score. Understanding this formula is akin to holding the key to deciphering your creditworthiness. So let's break it down, shall we? Your credit score, that all-important number that can make or break your financial dreams, is primarily influenced by 5 key factors. First up, and most important, is your payment history. That's right, folks, paying your bills on time is a big deal in the credit score world. It accounts for a whopping 35% of your score. Late payments, defaults, and bankruptcies, they're like kryptonite to your credit score. Next up is credit utilization. This is essentially how much of your available credit you're using. It makes up about 30% of your score. The rule of thumb here is to use less than 30% of your available credit. So, if you have a credit limit of $10,000, try not to carry a balance of more than $3,000. The third factor is the length of your credit history. The longer you've been borrowing, the better. This makes up about 15% of your score. It's like a trust factor. Lenders like to see a long history of responsible borrowing. Then we have new credit. This is about how many new accounts you've opened recently. It accounts for about 10% of your score. Opening a lot of new credit accounts in a short period of time can signal risk to lenders. Finally, we have credit mix. This refers to the types of credit you have. It's better to have a mix of different types of credit, like credit cards, car loans, and mortgages. This also accounts for about 10% of your score. In a nutshell, your credit score is a reflection of how you handle your financial responsibilities. It encapsulates how you manage credit, showcasing your payment history, the amount of debt you carry, the length of your credit history, and types of credit in use. Each of these components contributes to the overall portrait of your financial habits. Each of these factors plays a role in painting that picture. Delving into the intricacies of these factors will not only unravel the mysteries of your current credit score, but also equip you with the knowledge needed to strategically enhance it. Remember, the key to a good credit score is consistent and responsible credit behavior. So keep paying those bills on time, maintain a low credit utilization, and be mindful of the types of credit you're applying for. It's not rocket science, but it does take some discipline and understanding. So you have a low credit score and want to improve it, but how? Don't worry, we've got you covered. Let's dive into some practical ways you can build your credit score. First, pay your bills on time. Sounds simple, right? But it's crucial. Late payments can significantly dent your credit score. If you're not good at remembering due dates, consider setting up automatic payments or reminders. Second, keep your credit card balances low. High outstanding debt can affect your score. Try to keep your credit utilization ratio. That's the percentage of your credit limit you're using below 30%. So if your credit limit is $1,000, aim to use no more than $300. Next, don't close unused credit cards. It may seem counterintuitive, but closing a credit card can actually lower your credit score. This is because it decreases your total available credit, which can increase your credit utilization ratio. So, unless that card has an annual fee, it might be worth keeping it open. Another way to boost your score is diversifying your credit mix. This refers to the different types of credit you have, like credit cards, student loans, mortgages, and auto loans. It might sound scary to take on different types of credit, but lenders like to see that you can handle a mix. Now let's debunk some common myths about credit scores. 1. Checking your credit score will not lower it. It's a so-called soft inquiry and doesn't affect your score, so go ahead and check your score regularly. 2. You don't need to carry a credit card balance to build credit. Paying your balance in full each month can actually help your score. Remember, building credit score is not a sprint, but a marathon. It requires patience and discipline. It might take some time, but with consistent effort, you'll see your score climb steadily. And with a higher score, you'll have more financial opportunities open up to you. So, start working on these strategies today, and watch your credit score grow. While you're working hard to build your credit, make sure you're not unknowingly hurting it. It's easy to fall into habits that may seem harmless but can actually damage your credit score. Here are a few common mistakes you should avoid. Late payments can be a major red flag for lenders and can have a negative impact on your credit score. Always aim to pay your bills on time. High credit card utilization is another common pitfall. Maxing out your credit cards can indicate to lenders that you're heavily reliant on borrowed money, which can lower your credit score. Applying for new credit frequently can also hurt your score. Each time a lender pulls your credit report, it can cause a small, temporary dip in your score. Lastly, ignoring your credit report can be a costly mistake. Regularly checking your report can help you spot any errors or fraudulent activity early, before they can do serious damage. Avoid these pitfalls and you're well on your way to a healthy credit score. So that's all you need to know about building a credit score. Let's do a quick recap. We started our journey by understanding what a credit score is, a crucial 3-digit number that lenders use to assess your credit worthiness. We then delved into how this score is calculated, considering factors like payment history, credit utilization, length of credit history, new credit, and types of credit used. Moving on, we explored various ways to build your credit score. From paying bills on time and keeping credit balances low, to not closing old credit cards and applying for new credit only when necessary. We also touched on potential pitfalls to avoid, like missing payments, maxing out credit cards, and applying for too much new credit. These mistakes can negatively impact your credit score. Now that you have this knowledge, it's time to put it into action. Start developing good credit habits today. Remember, a good credit score opens doors to financial opportunities. Start building yours today. To learn more motivational and financial tips, watch the next videos recommended by YouTube here. Thanks for watching.